Good afternoon, ladies and gentlemen, and welcome to the Octopus Renewables Infrastructure Trust plc investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Chris Gaydon. Chris, good afternoon, sir.
Good afternoon, and thank you to everybody for joining us for this interim results presentation for Octopus Renewables Infrastructure Trust. My name is Chris Gaydon, and I'm joined today by my colleagues David Bird, Genevieve Legg, and also Charlotte Edgar. So for those of you who are less familiar with ORIT, we consider that ORIT is the only genuinely diversified investment trust of meaningful scale in the sector. And by that I mean true diversification across both technologies and geography. Our portfolio today consists of 40 investments spread across 5 countries and 5 technologies. And we now have generating capacity of almost 800 megawatts. And this diversified portfolio was put together based on our mandate at IPO, and we're very pleased to have delivered on what we said at that point. The diversification is just one element of why ORIT is different. We're also lucky to be part of a wider fund management team called Octopus Energy Generation. We have around 150 specialist renewable energy investors. We hire people from industry who've got experience building and operating wind and solar projects all across the world. The third reason why ORIT is unique is because of the added value or the growth component in our mandate, which means that we're able to invest into construction projects and also back developers with the aim of securing an additional element of capital growth. And fourthly, the other benefit of backing developers is it gives us access to the pipeline of projects that they're developing. When those projects become ready to build, we have the option to invest in those, secure those projects, and importantly do that outside of a competitive process. And then finally is ORIT's approach to sustainable investing. So impact and ESG principles thread their way through pretty much everything we do at Octopus. Something that is extremely important to us. We're an SFDR Article 9 product, and creating impact and additionality is something that we have always sought to do with this mandate. So the combination of ORIT's current portfolio and our growth mandate mean that we think ORIT is as relevant today as it's ever been. As I mentioned, the platform is now well established with almost 800 megawatts of existing operational renewables. We continue to deliver stable financials with a 12.9% return during the first half of 2025. And our portfolio continues to produce clean, green, renewable energy. And over the period, that's enough to have powered almost 160,000 homes. And we'll come back to some of these key financials shortly. I'm just going to touch on the corporate activity that has taken place during the period. So back in March 2025, we set out our capital allocation goals for the year. And it consisted of 3 key components. So the first of those was extending our share buyback program to £30 million. Now, as of today, we've bought back a little over £22 million. And the remainder of that headroom is available for the board to continue buying back shares as they see fit. The second pillar of our capital allocation strategy was to reduce debt to under 40% of gross asset value by the end of the year. As of the 15th of September, our leverage was 47%, That is flat period on period. And as we continue with our asset recycling strategy, we look to bring that down, as I say, below 40%. And then thirdly is that asset recycling strategy. So we have said that we aim to sell at least £80 million of assets. We have a number of sales processes which are currently underway, and we are confident that we remain on track to hit that target. Okay, so now just taking a look at the financial results. So during the period, we saw relatively stable performance from the portfolio. Both NAV and NAV total return was slightly down as a result of both share buybacks and rising discount rates. And that has led to NAV of £540 million at the period end, or 99.5 pence per share, and a minus 0.2% total return for the period. And all of that means that NAV total return since IPO now stands at £31.7 million. Total shareholder return during the period was 12.9%, and our gross asset value for the portfolio stands at a little over £1 billion. Just taking a look then at where we are on dividends. So at the start of the year, the board announced a target of 6.17 pence per share, and that represented an increase over 2024 in line with CPI of 2.5%. Now, so far we've made good progress. So we declared a 3.08 pence per share dividend or interim dividend, and we also delivered relatively strong dividend cover at 1.19 times. For those of you who are interested in dividend cover excluding debt amortization, that would stand at 1.81 times for the period. Looking ahead, we expect to both meet our 2025 full year dividend target and also to do that while remaining fully covered. And this slide really just shows how the dividend has progressed over the years since IPO. We do have a progressive dividend policy, but over the past 4 years, we've been able to increase the dividend in line with CPI, and that was the same for this year as well. I think what's important for shareholders at the end of the period, the dividend yield was 8.4%. And based on today's share price, that dividend yield is closer to 10%, which we think is quite an attractive opportunity. Now, with that, I'm going to hand over to David.
Thank you, Chris, and hello to everyone joining online. I'm going to run through the performance of the operational assets within ORIT's portfolio that have generated the cash flows that have gone towards meeting those dividends and covering them, as Chris set out. So during the first 6 months of 2025, those operational wind and solar assets delivered output of 654 gigawatt hours. And that's broadly the same as what we saw in the prior period, so the first half of 2024. However, underneath that headline number, there were quite a lot of changes in the makeup of where that generation came from, reflecting the changes we've seen in the portfolio since the first half of 2024. So taking solar, for example, we saw a 34% increase in output from our solar portfolio compared with the first half of 2024. And that was driven by the Breach Solar Farm in Cambridgeshire coming online in the middle of last year, as well as having a full period of generation from the Harlockstown site in Ireland. In contrast, on our onshore wind portfolio, we saw 18% less output than the first 6 months of 2024, and that's principally driven by the sale of our Ljungbyholm wind farm in Sweden, which completed in the second half of last year. Looking at how that generation flows through to revenue and EBITDA, revenue was £68.7 million for the first 6 months, and EBITDA £44.3 million. And those figures are again broadly in line with the same period last year. Overall, the output was 8% below budget, and I'll go into the reasons for that on the next few slides. And that flowed through to revenue being 6% below budget and EBITDA 7%. So you can see that the pricing we received for our generation was broadly in line with expectations, as were the operational costs, and the financial variances were driven by the lower than expected output. Going through the different technologies one by one, you can see the benefits of having both wind and solar in the portfolio came through in the first 6 months of the year, because whilst, as we'll get onto, wind speeds were lower than expected, we saw really strong irradiance on our solar portfolio, particularly in the UK and Ireland. However, we were not able to fully capitalise on that higher than expected solar irradiance, principally because of curtailment on the Irish grid around our sites near Dublin. That meant that the full potential export of those sites was not able to be pushed out into the network. We do receive some compensation when this happens. However, of the roughly 30 gigawatt hours of lost production, only around 5 were compensated in respect of Ireland. However, there is an ongoing court case in respect of the way the Irish grid operator manages compensation for curtailment and whether that's compliant with European law. So there is a possibility that we do in fact recover the rest of that missing generation should the court case find favourably for our portfolio. Looking at our wind portfolio, you can see that the roughly 15% below budget generation on our onshore wind fleet was overwhelmingly driven by the weather. In other words, the average wind speeds that we would expect were not met in the period. We saw lower wind speeds than we'd expect. You can also see some curtailment coming through on our wind portfolio. However, unlike the solar, we have been substantially fully compensated for any lost output there. The below budget wind speeds also affected the Links offshore wind farm in the North Sea. However, the variance there was much lower than what we saw on the onshore portfolio. All of that generation contributed to the positive impact that comes from ORIT's assets. So the output of those sites was enough to power around 160,000 homes, and that avoided carbon dioxide emissions from displacing fossil fuel generation, totaling around 165,000 tonnes. However, we have many more ways that we deliver impact through our portfolio. So throughout the period, we have continued to deliver on our impact initiatives, and more detail on the wide range of activities we are carrying out there are available on the ORIT website. Moving on now to the investment activity that we carried out in the company during the first 6 months of the year. And in line with the 2025 capital allocation priorities, which Chris mentioned earlier, we have been very selective and disciplined in terms of new investment during the first half of the year. The one material commitment that was made to a new project was a €27 million commitment to acquire the Irish Town solar project in Ireland. This is a 33 megawatt site which will form the 6th site of our existing Ballymacarney complex just north of Dublin, and we will acquire that once it's operational in the second half of next year. And we viewed this acquisition as being particularly attractive for ORIT shareholders because we were able to agree a very attractive purchase price, because this site needs to make use of the grid connections that we control at one of our existing sites. The remaining investment activity has been concentrated on our developer portfolio, which is where some of the highest potential returns are available. During the period, the Simply Blue Group was able to receive additional external funding, not from ORIT, for its sustainable fuels business. And ORIT has retained a 22.5% in that newly hived out business, which is called Nova Sustainable Fuels, as well as retaining our existing stake in the remaining Simply Blue offshore wind business. The new money that ORIT has put into developers consisted of a €3.4 million commitment to Nordic Generation, which is looking to bring onshore wind and solar projects through to ready to build in Finland, and also a £1.5 million commitment to BLC Energy, who are developing solar and battery projects in the UK. Both of these two developers have shown strong progress with their pipelines over the period, and each have projects that we would hope come through and are ready to build some point during 2026. Looking then at the portfolio at the end of the period, we have around 800 megawatts of operational generating capacity, which you can see here is spread out across a range of countries in Europe. Important for that diversification against different weather patterns. The one material change during the period was that we did not take up the option to contribute to the construction costs of the Woburn Road battery project in the UK. So that's the one small reduction in capacity compared with the start of the period. And you can see here the diversification that we have in the portfolio through another lens. So a good spread of countries and a roughly even balance between solar and wind generation, alongside 4% held in developers. We do have around 96% of the portfolio in operational assets, and I'll come on to later how we think that might change as part of our newly launched ORIT 2030 strategy. Looking in more detail at the expected revenues from our portfolio, you can see that ORIT continues to benefit from a very high level of fixed price revenues. So not just in the next 2 years, where 85% of the expected revenues are fixed price in nature, but going right out into the early 2030s, we maintain a very high level of contracting. And indeed, because we have a number of newer assets, including some that we have successfully bought through construction, we have fixed price revenues going right out into the early 2040s. And that newer than average portfolio for the sector means that we have a far more stable long-term revenue profile than a portfolio concentrated on older legacy subsidy assets. Those cash flows also benefit from a high level of inflation protection. So around 47% of our expected revenues from the portfolio of assets are explicitly contractually inflation linked over the next 10 years. And it's important to note with both of these last two slides that this represents the expected revenues from our current portfolio as it stands today, so it does not take into account the asset sales that we expect to complete later in the year. Finally, in the portfolio, we continue to have a 4% allocation to development, which forms part of a maximum 5% in our investment policy. I've talked already a little bit about Simply Blue Group and Nova Fuels, as well as Nordic Generation and BLC. And the remaining developers are Wind2, who are looking to bring through onshore wind projects in the UK, and Hyro, which is a joint venture developing green hydrogen projects also in the UK. We benefit from the right to fund projects as they come through to ready to build if we choose to, in accordance and in proportion with the stake that we hold in the development business. And if we look over the next 4 or 5 years, there's around 2 gigawatts of that pipeline that we might reasonably expect to come through reaching ready to build, and around 1 gigawatt which we class as advanced pipeline, so having at least 2 of the 3 of land rights, planning and grid. So with that, I'm going to hand over to Jen to talk through the valuations.
Thanks, David. As you can see from the NAV bridge, the NAV per share declined in the period and moved from 102.6 pence at the year end to 99.5 pence at the 30th of June 2025, with total NAV at £540 million. I'll touch on each of the movements left to right before going into a bit more detail on the next couple of slides. But the key value movements in the period were changes to economic assumptions, which includes inflation, FX and tax rates, which contributed to a 2p uplift to NAV. The developer valuations were adjusted, and that's particularly downward revisions to the Simply Blue valuation, which was offset by gains at Norgen, which contributed a net 0.7p decrease. Power prices and green certificates contributed minus 1.2p, which reflected primarily lower near-term forward prices. Discount rates rose in the period in line with market evidence, which equated to a 1.3p decrease to NAV. And these downward movements were offset by the balance of portfolio return, which added 2.5p to NAV. And that's mainly made up of the return on the portfolio as cash flows are brought forward 6 months further forward. And this movement also includes some negative performance adjustments and minor updates to OPEX and CAPEX assumptions. So then after dividends of 3p, fund costs of 2p, and then share buybacks, which had a net 0.7p overall uplift, we finished the period at 99.5p. So then just looking at the macroeconomic assumptions, the assumptions used in the valuations were largely unchanged since the year end. The couple of changes were that UK RPI for 2026 to 2029 was revised upwards to 3.25% from 3%, but the long-term assumption remains fixed at 2.25%. Also during the period, Finland's corporation tax rate was reduced from 20% to 18% from 2027, which increased valuations, and assumptions for our French, Ireland and Germany were unchanged. On power prices and green certificates, the valuations decreased by £6.8 million over the period. On the near-term power prices, the roll forward of the use of forwards by 1 year was the single largest driver of the valuation reduction. Our methodology is that we'd always use transparent traded forwards for the near term before transitioning to consultants' longer-term forecasts, and using the forwards for an extra year, which had a lower price, had an impact on the valuations. The underlying forward prices also softened moderately across most of the core markets, and this was partially offset by updates to green certificates and capacity markets, where we saw slight upward revisions to those prices. Crucially, though, the portfolio is well protected in the near term, with 85% of forecast revenues for the next 24 months either being fixed or contracted. So that really limits our exposure to any market volatility. On discount rates, our weighted average discount rate implied by the valuations increased to 7.9% from 7.4% at year end. We note that the discount rates shown on this table are presented on a like-for-like basis, and the 7.9% quoted reflects the sterling fund return. The increase during the period mainly reflects persistent high interest rates across our core markets, as well as the introduction of a new project level financing, which is our new UK holdco facility, which lifted the blended cost of capital on the UK portfolio. On an adjusted basis, after adding back the expected returns from our development assets and also the increased leverage from our RCF, the implied discount rate is 8.2%. On debt, at the end of the period, total borrowing stood at £470 million, which equates to gearing of 47% of gross asset value. During the period, the RCF was resized and extended, and that cut our commitments from £270 million to £150 million. And we also refinanced £100 million of that RCF into the new UK holdco facility, which carries a lower borrowing rate. These two actions lowered our average cost of debt to 3.6%, down from 4% at the end of December. At the same time, the portfolio is also now more highly hedged, so 71% overall, with project level debt hedged at 85%, and that significantly reduces our exposure to movements in floating rates. We do acknowledge that gearing is temporarily elevated by buyback activity, but with asset sales underway, we remain on track to bring it down below 40% by the year end. And with that, I'll pass back to David.
Thanks, Jen. So I'm now going to talk about the new ORIT 2030 strategy that was announced alongside the results. And this reflects acknowledgement that the renewables investment trust sector and ORIT have been suffering from very wide discounts to net asset value over recent years, and that something needs to be done to address that. So I'll go into a bit more detail around the capital allocation priorities shortly. But firstly, I'll talk through what our strategy for ORIT 2030 is. And this is built on 4 pillars: grow, scale, return, and impact. Taking the focus as part of ORIT 2030 on investing for capital growth through deploying into construction and assets in particular, alongside continuing to support developers up to our 5% limit. And this is really a refocus on the strategy that ORIT launched with back in late 2019. We have always set ourselves apart by wanting to deliver capital growth alongside the attractive income, and doing that through successfully managing the market conditions have forced us to focus on buybacks and balance sheet management. Secondly, scale. We have heard very clearly from a large range that whilst we can deliver a significant portion through organic activity by growing NAV through delivering construction and development gains, in order to reach £1 billion, we will also need to see inorganic growth. For example, M&A activity, mergers at the corporate level. In delivering this strategy, we believe we can deliver returns of 9 to 11% over the medium to long term. And this will continue to be underpinned by an attractive, growing, progressive dividend, which will be fully covered by operational cash flows.
They keep dropping out.
Sorry, I'm not sure if people can hear me still. Is there a problem with the audio?
Hi guys, we can hear you again.
Should I recover this slide?
Yes, please.
Okay, so apologies if there's a bit of duplication here. I'm not sure what could and couldn't be hurt. But I'll run through the 4 ORIT 2030 priorities once again. So the 4 priorities here are grow, scale, return, and impact. So the first of these, grow, this reflects a refocus on our original IPO objective of delivering more than just income, but also delivering capital growth through investing in construction projects. This is something that we have always had as part of our strategy and have delivered successfully historically, but have not been able to do so much of over the last couple of years because of market conditions. Secondly, scale. So we have heard very clearly from investors that they would like to see larger, more liquid vehicles in this space, giving them access to the energy transition opportunity. And so we've set an ambition of growing ORIT to an net asset value of at least £1 billion by the end of 2030. That is a significant increase from where we are currently at around 540 million. And whilst we can deliver a significant proportion of that through organic activity, through delivering NAV growth through construction and development gains, in order to reach £1 billion, we will also have to deliver inorganic growth. So M&A, merger activity at the corporate level, for example. Thirdly, on returns, we believe this strategy will enable us to deliver a 9 to 11% total return to investors over the medium to long term. That will continue to be underpinned by a dividend which grows progressively from where it is today, and with those dividends fully covered by operational cash flows. But we will also be adding that element of capital growth that comes from the construction and development activity. And lastly, impact. So ORIT is an impact fund, and through refocusing on delivering new projects onto the grid, we will increase the impact that ORIT is delivering through those additional megawatts of generation and storage capacity coming through, helping to transition to an electrified green economy, with wind and solar not only decarbonising, but also delivering enhanced energy security as we reduce reliance on fossil fuels brought in from overseas states, and also in the long term reducing costs for consumers, because wind and solar are the cheapest forms of generation available. So how are we going to go around building the portfolio as we deliver the ORIT 2030 strategy? And you can see here a marked contrast from where the portfolio sits today at 96% in operating assets. We will continue to have a bedrock of operating assets to support the dividend, but we should expect to see construction increasing from where it sits today at effectively zero, up to potentially 20% or more of the portfolio at any given time. Meanwhile, we will continue to maintain that investment policy limit of around 5% in developers. So looking at how ORIT 2030 sits together with those priorities that were set out earlier in the year for 2025, firstly, touching on the return target. The IPO we launched with a return target of 7 to 8%, but this was in an environment where base rates were close to zero and long-term risk-free rates were also very low. So frankly, that target had become stale. By re-engaging with that construction element in our mandate and reflecting where risk-free rates now sit, we believe that the 9 to 11% total return target is highly deliverable. Secondly, in FY 2025, we have been focused on buybacks in preference to investing in construction. And clearly, buybacks do deliver capital appreciation in terms of NAV per share. But it's a short-term tool, and what they certainly haven't been successful in doing, either for ORIT or for other companies in the sector, is driving any lasting improvement in the discount to net asset value. And the other concern with buybacks is, with assets such as ours, which are finite in life, if you are not reinvesting in new assets, bringing new assets into the portfolio, eventually cash flows start to run off and NAV declines over the long term. In contrast, as part of ORIT 2030, by investing into construction and development assets, we keep refreshing the portfolio and we keep delivering NAV per share appreciation, and are therefore able to deliver more sustainable NAV per share accretion and better overall return outcomes to investors in the medium to long term. We also set out, as part of our 2025 priorities, that we wanted to bring gearing below 40% of gross asset value, and that absolutely remains part of the strategy. So we are on track to deliver that later on in 2025. And as part of ORIT 2030, whilst we will make use of short-term borrowing to temporarily increase debt above 40% at times, we will always anchor gearing below 40%. And we can deliver that through selectively recycling existing, perhaps more mature operational assets in order to fund the construction activity and the reduction in borrowing that's needed to maintain the 40% anchor level. And lastly, ORIT 2030 clearly delivers a much more impactful contribution through bringing new capacity on alongside the benefits of the operational capacity. So to wrap up before we go to questions, so we lost connection again. Sorry, a minor technical issue there again. Apologies for that. So to sum up everything we've talked about before we go to questions, we see ORIT and what we've delivered over the past 5 or 6 years as giving us a real solid base for moving on into the 5 years of ORIT 2030. We have that almost 800 megawatt operational portfolio that delivers highly contracted revenues to support the dividend. That dividend has been growing consistently year on year, and we expect to be able to keep growing the dividend and keep fully covering that by operational cash flows. And by shifting towards a renewed focus on construction activity, we can deliver ever more impact through bringing that new generation in. And so with that, I'll hand back to the IMC team briefly to talk through how to ask your questions.
Perfect, guys. That's great. And thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that have been submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboards. Guys, as you can see there, we have received a number of questions throughout your presentation this afternoon. And thank you to all of those on the call for taking the time to submit their questions. But Charlotte, at this point, if I may hand over to you just to chair the Q&A with the team, and if I look to pick up from you at the end, that'd be great. Thank you.
Great, thank you. Thanks, team. A couple of questions. The first is on organic and inorganic growth, and there's a couple on this theme here. Slide 37 talks of a combination of organic and inorganic growth. Have you considered offering to reverse yourself into your sister company, Fern, who are flush with new IHT investor subscriptions and the sale of a 425 megawatt gas peaker portfolio? And on the same theme, we have another question. If scale is beneficial, why the board not considering corporate activity with some of your peer competitor trusts? I think they can both be covered in the same answer.
Yeah, so on the sort of specific one referring to Fern, so for those who are not familiar, Fern Trading is a business which receives management services from Octopus Investments. Appreciate that the sort of Octopus family of companies is increasingly sort of large and complex and perhaps not easy to follow. And in fact, our team used to sit as part of Octopus Investments, but we now sit as part of Octopus Energy, which was related, is now a fully separate business from Octopus Investments. So it's not strictly accurate to describe Fern Trading as a sister company, although there are definitely connections there, and indeed others in the Octopus Energy Generation team are involved in managing some of the energy assets in that trading business. I think if you step back and look at both questions around M&A activity, we think that within the renewables investment trust sector, there are still more vehicles than there need to be. We don't need sort of multiple vehicles with very similar single country, single technology mandates, certainly not as many as there are. And so we think there are clear benefits of having a smaller number of larger, more liquid vehicles. And that is part of why we have set that large, ambitious target for 2030. But we also strongly believe that for these renewables companies to be successful in the long run, they need to be delivering value-add activity. They need to be bringing new assets through rather than just sitting on existing operational assets. And ORIT is one of very few companies in the sector which has that as a core part of its mandate, and where we have the track record. So we've delivered around 500 megawatts of capacity through into construction, either in ORIT's ownership or with ORIT oversight as part of forward purchases. And the Octopus Energy Generation team has way more experience than that. So around 3 gigawatts of construction projects have been brought through in our team's management. So we think ORIT is particularly well placed to be a consolidator. And we have in the past sought to drive this. So our board have absolutely been considering the possibility for merger activity in the past. And it's absolutely part of the strategy that we pursue similar activity as well. It is not straightforward to make that happen quickly, but ORIT 2030 is a 5-year roadmap. And so we absolutely hope and expect that in that period that we will be able to drive some consolidation activity. I think the sort of question around Fern, it's not what we're thinking about when we think about driving that activity, because we think the investment trust structure is something that makes a lot of sense for this asset class, and ORIT is a sort of clear candidate to be one of the consolidators in that structure.
Great, thank you. Next question, I can probably make a start on this. If we assume that X billion of private equity investments with Octopus Energy are all in the same type of assets as those of ORIT, I don't understand why those private equity investors don't just buy ORIT shares to effectively get those same assets at a chunky 30% discount. I think that's a fair question, but what we've found is that a lot of the investors in the private funds, they don't like the volatility of the share price, so they hold the assets at NAV. But agree, it doesn't always make sense that they want to hold it NAV versus the 30% discount. However, I think there's just a slightly different investor that comes into those types of vehicles.
So I totally agree with that. And we speak to private investors a lot across a number of topics, including how they can cooperate with ORIT, both at an asset level and at a PLC level. And certainly, these sorts of investors do not want to be marking their book on a daily basis and be exposed to some of the risks which create share price volatility, which are not always tied to the underlying value of the assets. I think the other thing I would say, certainly on the face of it, it looks attractive at a 30% discount, but if someone was to make a meaningful investment into ORIT, then I think that 30% discount would contract quite quickly.
Great, thank you, Chris. Question on the assets being prioritized for disposal. So which types of assets are being prioritized, and at what discount or premium to book value do you expect sales to occur?
So I can happy to take that one. So which type of assets are being prioritized for disposal? So essentially, when we're doing our asset selection for disposal, we look at those assets which will allow us to maintain various key metrics at the portfolio level. So for example, we don't want to start to have a big impact on the diversification. We don't want to increase our exposure to wholesale energy prices. So that is sort of the guiding principle for how we choose assets. If you look at our disposal history to date, we've sold the Ljungbyholm wind farm in Sweden. That one was selected partly because it met the criteria I just mentioned, but also because it was a good opportunity for us to prove the buy, build, operate and sell strategy, which is core to ORIT's mandate. If you look at the Polish wind farms that we've sold, they were more opportunistic, where we found a buyer who was willing to both transact quickly and also at a very attractive premium to our holding value. The option to build the solar farms in Spain that we exited, again, there we had some quite unique leverage in those agreements that allowed us to exit those options at a premium. And in terms of the processes which are currently underway, I can't really say a lot about them at the moment. We did say in our capital allocation strategy that we're looking to complete those sales by the end of this year. Touch wood, we remain on track. And in terms of premium to book value, well, we mark our book to our view of what the market is. So I think it's going to be, I think time will tell. I think it's a bit difficult to say that we'll sell at a premium, given we are marking them to market.
Yeah, I guess we always expect to sell in line with book value and hope to do slightly better than that, and that's sort of where we are with these processes. I think the other point I'll just add on the selection is clearly and linked to the ORIT 2030 strategy is, whilst Jen talked through the average sort of expected return on the current portfolio, there is a range within there, and so there are certain assets where we have delivered uplift through construction, and in having delivered that increase in value, the forward-looking return sort of starting from today's values is slightly lower than when we invested. And so recycling out of assets where we've already delivered a lot of value and there's potentially lower forward-looking return expectations, less value to be added, and then with the proceeds looking to reinvest into new opportunities where there's higher return expectations, more value to be added.
Great, thanks both. Got a couple of questions on the longer term performance of ORIT. One question cites that NAV has fallen by 9% over the last 3 years. What are the reasons for this, and what are your plans to reverse the trend? Similar question, presentation appears to suggest that everything is on track in terms of shareholder returns, but I can see that the net asset value per share is decreasing over time, as well as the share price, even if dividends are strong. What is causing this? Are the shares being priced by the market on a different basis to NAV, for example, on a yield basis?
So yes, NAV has declined. I think if you look at the headline NAV movements, it's important to remember that there have been share buybacks in the last sort of year to 18 months, which clearly reduce NAV, but can be accretive to NAV per share. And also that we have been paying out dividends. So over 6 pence a share last year and 3.08 pence in respect of the first half of this year. So although NAV might be declining, that doesn't necessarily imply that NAV total return is negative. It was broadly flat, about minus 0.2 in the first 6 months of the year. And I guess what that is showing is that the sort of the return on the assets is not keeping up with the dividend in the way that we would like. There's a few things behind that. So Jen talked, for example, about the increase in discount rates that we saw in the first half of the year. That reflects that underlying rates have gone up, and that does not necessarily perfectly one for one, but it does eventually flow through into what people are willing to buy and sell these assets for. There does need to be some risk premium over bonds and similar. So we've seen a few things that have weighed on performance in the last 3 years. So discount rates rising is one of them. I think in that 3-year period as well, you're going back to 2022 when power prices were at that peak. And we all expected power prices to fall from those peaks, but they fell faster than expected in 2023 and 2024. So again, that's weighed on returns as well. And the other thing we had, particularly in the early part of that period, was a dramatic increase in borrowing costs. So again, the return that was coming through in terms of the cash flows from the assets was able to service the dividend, but then when you factor in also the borrowing costs, that was slightly outweighing the return that was coming off the assets. Looking forward, and why do we think that we can deliver a 9 to 11% NAV return? So effectively not only paying out a dividend that might be in the order of sort of 7% of the NAV, but also adding return in terms of capital growth on top of that. Partly it comes down to the opportunities we're seeing in the market. Now, it is probably an easier market to buy assets at good prices in than it is to sell assets right now. We are working very hard on the asset sales and confident that we can deliver good outcomes, but it is harder to achieve than it might have been a few years ago. But that gives lots of reasons to be optimistic about those construction opportunities. Now, we've seen perhaps the gains that can be delivered from constructions, the sort of spread on returns between a construction asset and an operational asset slightly increasing in the same period as well. So there's lots of opportunity out there, and we're confident that we can go and deliver it.
Great, thank you. Looking at the ORIT 2030 strategy, with the 5-year plan to increase exposure to construction assets, which won't initially generate income, can you talk about how you will manage dividend cover and maintain the progressive dividend policy?
Yeah, so there's obviously a lot of work and scenario analysis that sits behind this, and absolutely, construction assets, are not going to contribute to dividend cover for that period from when we start construction through to when they come into operations. However, the work we're already doing with the asset sales, and again, there was a question on how do we select assets for sale, and I talked about return profile. Dividend yield is one element of that return profile. So making sure that when we're recycling assets, that we are potentially selecting assets that have a lower contribution to dividend cover for what we might sell in the immediate near term. And then also looking at the use of those proceeds. So we have assets with long-term amortizing debt facilities where those facilities were put in place a number of years ago and have quite high levels of scheduled debt payments in 27, 28, 29, for example. We're able to target some of the proceeds from asset sales once we've paid down the RCF to effectively reshaping the debt profile on some of the remaining assets. And that gives us a lot of breathing room to be able to then incur borrowing potentially to fund construction without jeopardizing the ability to pay a covered dividend. But it is a huge part of the active management that we have to deliver as part of this portfolio.
Staying on ORIT 2030, and I think we've broadly covered it, but just so we're absolutely explicit here, buybacks have been a worthwhile strategy, is the starting comment, but will ORIT 2030 require this to be undone by issuing new shares in the future to fund this approach to construction?
So ORIT 2030 at its core is not dependent on new equity issuance. So we can deliver the construction activity through a combination of short-term borrowing and then selective asset recycling in order to keep gearing at the right sort of level and maintain a robust and resilient balance sheet. Clearly, we would all like to get back to a place where we can issue new equity and can effectively fund construction from that, but we don't need to do that to deliver the investment for growth and the return parts of ORIT 2030. I think if you look at the scale element of ORIT 2030, again, equity issuance is one route to that increased scale. We are not sitting here assuming that that is going to come through in a meaningful way, certainly not in the next couple of years, but 5 years is a long time, and we certainly hope to be back there. But if not, we have talked already around consolidation as the other route for inorganic growth in the scale of the company. So short answer is no, we're not relying on equity issuance, but yes, we would love to get back to that place if we can.
And turning to asset sales, how is the market for disposals currently? There are a lot of investors trying to offload assets. Is there still plenty of demand?
So it's a good question, and it has become sort of very much a buyer's market at the moment. And in particular in the UK, where the traditional buyer of renewable energy assets were the listed investment trusts, which is, as we know, are all, well, they're not buyers at the moment. So that has led to us sort of looking further afield for buyers for the assets that we're looking to sell. We know that there is still capital available at our valuations because our private strategy, which has very similar targets to ORIT, is still raising lots of capital. And so for us, it's the matter of speaking to those sorts of investors. Yeah, I'm not sure what else add to that, really. Yeah.
Cool. Thanks, Chris. Please could you share your view on why the forward curves have been falling recently? Do you feel they've fallen enough? And do you have a view of where they might go in the short to medium term?
So I'm assuming this relates to forward curves for power prices. Not 100% sure, so
yeah.
Apologies if that's not the right interpretation. I think we've seen a bit of volatility actually in forward curves over the course of the year. They rose quite steeply in the middle of Q1 before coming down again towards the end. In case it wasn't clear, I think one of the reasons that forward curves had a noticeable impact on valuations in the first half of the year is, as Jen described, the approach we take to valuations, which uses forwards for the first few years. And so when we extend the period on which we're taking forwards, it happens at the moment that structurally in Finland in particular, the forward curve has been quite flat and is lower than where long-term forecasters think power prices will go. I think one of the big drivers there is, I think we're all pretty confident that there is a significant growth in energy demand coming through, or electricity demand in particular coming through from a huge range of sources, including the momentum that is already there on rollout of electric transport, particularly in the smaller and medium weight vehicles. We're seeing, again, particularly in the Nordics, lots of movement towards electrification of heating as well in a market where there's a lot of biomass at the moment. And then there's a huge amount of growth expected in data center demand, not all of it from AI. There's already a lot of data center growth in the Nordics, but the timing of that is always a little uncertain. So I think what we've seen over the last few years is new generation has been built out slightly more quickly than was expected. And those new sources of demand, whilst they have started to come through, are not coming through quite quickly enough to offset. The other thing we've seen, again, is gas storage in Europe, which was a real concern a couple of years ago on our ability to have enough gas in storage to meet sort of winter requirements, particularly with not wanting to use Russian supplies. Actually, Europe's done a very good job of getting gas into storage, and that's brought down power prices as those pressures have alleviated. The other big factor is hydro. So there's a huge range of factors. There's always room for forwards to move up and down, but I don't think we see huge. They're already at a pretty low level in the markets where it's relevant to us at the moment, and so it's not to say there's no risk, but there's a lot more upward potential in terms of just where the level is. But there's always a risk that forwards could fall further.
Great, thanks. I think we've got time for a couple more questions. This one I think has been covered earlier, but might just be worth reiterating very quickly. With operational asset sales, will your dividend cover reduce? And if so, what is your target for this metric?
So dividend cover in the first half of the year, as we said, was 1.19 times. We expect also to have a fully covered dividend for the full year. And we do not expect dividend cover to be compromised as part of either the asset sales or the shift to a more construction-focused strategy. We don't sort of have an explicit target level for dividend cover, but a level of around 1.2, 1.3 times is a level that we think is appropriate given the high level of contracted revenues that we have. If we were to target a really high level of sort of post-debt service dividend cover of pushing 2 times or something like that, I think it would be a sign for us that we are not doing enough of the growth-focused activity to drive capital growth into the portfolio.
Great, thank you. Question on the portfolio mix. How do you see the technology mix evolving given strong solar output but weaker wind performance?
So I don't want to sort of get involved in pseudoscience because I know there's a lot of discussion around what will be happening to wind speeds as a result of global warming. And certainly there's been a few years of lower wind speeds. So that's something we and many others continue to look at. For the time being, we maintain a fairly even split between wind and solar in the portfolio. And I think what investors could expect to see is the introduction of some batteries. And that's because we think that there is an interesting natural hedge between batteries and intermittent generating technology. Our analysts are doing a lot of work working out what is the optimal technology mix in each of the markets where we're operating, and also ensuring that we sort of continue to maximize the benefits of diversification. So I think for the time being, wind and solar roughly even split, but expect to see some flexibility come into the portfolio.
Great, thanks, Chris. I think we're at time, so perhaps one of you could give some closing remarks.
Yeah, I think with the questions, if there are questions out there we haven't had time to answer, hopefully we'll be able to get those from the IMC team and potentially publish a follow-up. But yeah, hopefully we've covered the main bits. And from our point of view, we just want to say thank you to everybody for joining, and hopefully the ORIT 2030 strategy is something that people find as exciting as we do. We think there's a huge opportunity here for investors in this sector. And particularly where discounts are now, we see there's plenty of value that people can find, and yeah, we look forward to updating people on the strategy as it develops over the coming years. With that, I'll hand back to the IMC team to cover any last admin.
Perfect, guys. That's great. And thank you very much indeed for updating investors this afternoon. Of course, we'll be able to give you back all of the questions that came in this afternoon for you to review afterwards. But apart from that, guys, thank you very much for your time. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Octopus Renewables Infrastructure Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.